but we had a huge company, huge. And we probably wouldn't be here today if the mortgage collapse didn't happen, but nobody saw it coming. But clients didn't see it coming either. So we created this beneficial company for them and for us to help them through this process and make money along the way, right? But what are the 3 components that you need to make one of these transactions happen? Do you know? You know? Do you know? The 3 components are a mortgage, a note, and a deed. Let's take one by one. What's a mortgage? You were perfect until you said that last sentence.
It's the monthly payment to your house, to the bank.
You were perfect until you just said the last thing. You're exactly right. You go to a bank, right? We go to a bank and we ask to get approved for a mortgage. So we borrow money from the bank to buy a house. So typically what happens is we go to like any mortgage company called Bank of America. We ask to borrow $300,000, okay? The purchase price of a house, say, is $360,000, okay? We need to put down 20% unless we do an FHA loan, okay, which is $60,000. So the client puts down a deposit so they have skin in the game, right? So this deposit is from the client, so $60,000. But the bank lends you $300,000 to purchase this $360,000 home. We understand that? So now I have $300,000 that I owe the bank. The bank puts a mortgage, which is a lien, on the house. So they put a lien of first position on the house. Okay? So what does that mean? That means in a month or two, if God is great to us, the house is worth $500,000 and you want to sell your house, what do you have to do first? You have to pay them back. So you can't sell the house because on your title report, it's going to show this lien position that they have a mortgage for $300,000 against the home that needs to be paid back first before you do anything. Okay? So I want you to think of a traditional listing. Traditional listing, I owe $300,000 on my house, right? That's what we talk about. My house is worth $500,000. How much equity do we have? 200. 200,000 in equity. That's what that means. That's your money. Equity is your money. But now, let's say on a short sale, I borrowed $300. I haven't paid my mortgage in 7 years. I owe the bank $600. How much negative equity do I have? Negative $300. You understand? There is no money coming to me. I'm upside down. There's no equity. You get that? It's very important, okay? So now back to this. The one instrument that they have is a mortgage against my house. That goes against the home. I can never sell it unless that's paid back. So that's the first thing. But that's not enough. Now they want a personal note and a personal guarantee from me, Mark Gallagher. So the note says, I, Mark Gallagher, am borrowing $300,000 for, say, 30 years at 6.5% interest rate, and the payment is $2,100 a month. So the note explains exactly the terms of the loan. So do they own my house? They don't own it. The homeowner always maintains the deed. And that's what you're creating. That's what you're doing here. When you're talking to these homeowners, you're trying to get them to come to a closing table with their deed so we can do a transaction. What we're trying to do, because it's a judicial state and it takes so long for the banks actually to go to foreclosure, the banks say, it's cheaper for me to make a deal today. Let me cut my losses. It's only been 2 years. It's only been 1 year. It's only been 3 years. This is going to take me 6 or 7 or 8 years. I'm going to lose all this money because remember, the banks have to maintain the properties. You know that, right? The banks have to make sure there's insurance on the property because if someone gets hurt, the banks are responsible. If the house burns down, the bank loses its collateral. You understand that? So the banks say to themselves they want to cut their losses. And what you're doing is convincing the homeowner also to get to walk away, maybe get some money, and then have a new life instead of the stress of the bank and the courts and all that nonsense that comes with it. You get that? But the bank does not own the home because you borrowed money. But the bank does have a mortgage against the house and then a note against you personally. Now let's talk and jump in this real quick. What's a modification? It's a modification to the note. So you understand, you know? Because look, guys, when you understand this, now you're that much more powerful when you're on the phone because now you feel confident that you can explain this all. All it is you're modifying these terms. So what are you modifying? Well, if you owe them $600,000, maybe they're going to make you a deal that you're going to pay them instead of $300, $400. Maybe instead of a 30-year term, they're going to do a 40-year term. Maybe instead of a 6.5% interest rate, they're going to lower the rate to 2%. And maybe the payment that you couldn't afford at $2,100, because they lowered the rate and they lengthened the term, even though they charged you a little more money, maybe what they're saying now is your payment's going to be $1,100 a month. And that's why they need the income. Because when they see the client's income, they're able to make a deal that makes sense for them and the client. Why? Why do you think they don't want to take the house? Exactly right. Exactly right. They're not in real estate. The banks make money by lending money. They don't want the house. How much do you think this person's paying now for this $400,000 note over 40 years? More. It's probably like $700,000 is the real note. They're probably paying $300,000 in interest over 40 years. The first year, nothing goes towards interest whatsoever. Nothing goes towards principal. Yeah, the first year, nothing goes towards principal. And then very little goes after that. So you understand? You get it? A short sale is just the bank saying, this is another way. If they can't do a mod because they don't have income and they're not going to pay me, there's another way that I could get out of the loan quicker because I'm going to take a bigger loss. Any questions? What do you got?
Can you sell the deed to somebody else?
So, yes. The answer is yes, you can. The answer is